Okay, so schedule of expected cash collection is very important as a planning tool as it identify the actual timing of cash flow which differ from timing of sales revenue recognition. So how to calculate the expected cash collection? First, we need to recognize the account receivable and put in November, and then we need to recognize for the November sales for current month and following month. So we conclude we have 255,000 and 85,000. And then for December sales, we also use the current month and following month, and we got 270,000 and 90,000. So the total expected cash collection for November is 338,200, and for December is 355,000.
The merchandise purchases budget for Cement Industrial Gas Corporation is a plan that tells the company exactly how much stock to buy based on their sales. Because of the cost of goods sold is always 71% of sales. Management can easily predict that 241,400 ringgit in stock will be sold in November and 255 1,600 ringgit in December. To ensure they never run out of product, the company follows a policy to keep a safety buffer in the warehouse equal to 75% of the next month's COGS. This following this forward-looking plan acts as a benchmark of norm to help manager control inventory and stay prepared for future demand. Following this logic, the corporation need purchase 252,050 ringgit of stock in November and 250,275 ringgit in December. Interestingly, even though December has higher sales, they actually buy slightly less stock than March. This is because January sales are expected to drop 350,000 ringgit. So the company doesn't need a large of safety buffer at the end of the year. This budget is also vital for manage cash flow as the company policy is to pay for this item in the month after they are bought. By setting these targets early, management can later check for variance to see if they stay on track and hold the right people accountable for costs.
Now I will explain about the cash budget for November and December. So for the month of November, we will get total cash available 360,400 from adding the cash collection with beginning cash balance, and then the total cash available we will subtract it with the disbursement, which is consists of purchases from previous month and also the other expenses. Then the total disbursement we will get is 217,600, and then after we subtract total cash available with the disbursement, we will get the ending cash balance, which is 142,800. And then the ending cash balance for the November, we will bring it into the next month, which is December, as the beginning cash balance, and we will add with the cash collection of 355,000, and then we will get the total cash available. Also, we will subtract it with the disbursement, which is the purchases from previous month, and then we will get the total disbursement of 273,450, and then we will get the ending cash balance of 224,350.
Moving on to question 1D, I will be presenting the budgeted income statement for Sema Industrial Gas Corporation covering the month of November and December. As you can see, the budgeted sales are 340,000 ringgit for November and 360,000 ringgit for December. According to the case details, the cost of goods sold is consistently estimated at 71% of sales. By setting up a quick formula to multiply our sales by 71%, Excel calculates our COGS to be 241,400 for November and 255,600 for December. Subtracting the cost of goods sold from our sales gives us a gross margin of 98,600 in November and 104,400 ringgit in December. Next, we factor in our fixed operating expenses. The case specifies that cash expenses are 21,400 per month, while non-cash depreciation is 21,200 per month. Using the sum function, our total operating expenses come up to a steady 42,600 ringgit for both months. Finally, by deducting these operating expenses from our gross margin, we arrive at our net operating income. The corporation is projected to bring in a net profit of 56,000 in November, which is safely arises to 61,800 ringgit in December due to the higher sales volume. Do note that corporate taxes have been ignored as per the instructions. I will now pass the presentation over to my teammate for the next section.
Okay, so next, budgeted balance sheet for the end of December. So this also very important because it provide a comprehensive overview of company financial position at year end. So the total asset that we got is 1,464,325, and it contain of cash, account receivable, merchandise inventory, property, plant and equipment for asset. And we also got the same amount for total liability and stockholder equity, and is contained of account payable, common stock and retained earning. Okay, next question 2, and we need to calculate direct labor rate variance. So we have the formula for labor rate variance, which is actual hour multiply actual rate, deduct with actual hour multiply standard rate. So we have the actual labor cost 21,920, and we need to deduct it with 3,400 hours multiply with 7 per hour, and we get 1,880 in negative, so it show as a variable.
Labor efficiency variant, the formula multiplies the standard hourly pay rate by the difference between the hour actual work and the hour budgeted. In this example, the company expected the job to take 3,200 hours. However, the worker are faster and finish the job in only 2,000 hours, saving a total of 1,200 hours. To find the final financial impact, the 1,200 saved hour are multiplied by the hourly rate of RM7 ringgit. This result of saving of 8,400 ringgit because the company spend less money of the labor than planned. Then the outcome is the label with an F for favorable.
So the formula used for price variance is actual quantity times with actual price minus with standard price. So for the first one, iron, the production team used 5,000 pieces of iron. So the actual price per piece was 2 ringgit, which exactly matched the standard price of 2 ringgit, and consequently there was no price variance, which is after we use that formula we will get 0, which indicating that the cost of iron was perfectly aligned with the budget expectation. And then for the copper, the production team used 2,200 pieces of copper. So the actual price per piece was 3 ringgit and 10 cent, which was higher than the standard price of 3 ringgit. So this result in an unfavorable variance of 220, because after we use the formula we will get the total variance of 220, So the unfavorable variance suggests that the company paid more for its copper than originally budget. So combining the result, the iron variance of RM0 and also the unfavorable copper variance of RM220 result in a total direct material price variance of RM220 unfavorable lah. So management should investigate the causes for the higher copper prices, such as supplier price increase, rush orders, or a failure to secure volume discounts to see if purchasing strategies can be optimized in the future.
Next, I will present the calculation for question 2D, which looks at the direct material quantity variance for October. As displayed on the screen, the general formula for the material quantity variance is standard price multiplied by the difference between actual quantity used and standard quantity allowed. Because Tanjung Piai Company used two distinct direct materials, which is iron and copper, we calculated the variances separately in Excel to find the net total. Let's look at the iron first. The standard price is RM2. Based on the actual production of 800 units, the standard quantity allowed is 4,000 pieces. However, the actual production team only used 3,900 pieces. Because the actual quantity used was less than what was standardly allowed, Excel calculates a favorable variance of -200. Moving on to copper, the standard price is RM3. For the actual production volume, the standard quantity allowed is 2,400 pieces. In this case, the actual quantity used was higher at 2,600 pieces. Since we use more material than planned, it results in an unfavorable variance of 600. Finally, we get a total direct material quantity variance of 400, which is unfavorable. This net unfavorable variance indicates that the extra copper usage outweighed our efficiency savings on iron during the month of October. I will now pass the presentation back to the next group member.
Overhead expenditure variance change measures the difference between the actual overhead cost incurred and the budgeted cost. Given the actual variable overhead is 12,000, the actual hour is 3,400, resulting from the addition of 2,000 normal time and 1,400 of overtime, and the standard variable overhead rate is RM3. This results for an amount of 1,800 classified as unfavorable. This shows that the actual overhead costs are higher than its budgeted costs. Overhead efficiency variance measures the difference between actual overhead and standard overhead costs. Given the actual hour is 3,400 hours and the standard hour is 3,200, resulting from the multiplication of direct labor of 4 hours per unit and the actual units produced of 800 units. The standard rate for variable overhead is RM3. Therefore, the variance is 600, classified as unfavorable. The fixed overhead budget variance measures the difference between actual fixed overhead costs incurred and budgeted fixed costs. Given the actual fixed overhead is 8,800, while the budgeted fixed overhead is 8,000, resulting from the multiplication of direct labor hour of 4,000 and RM2 as the fixed overhead rate. The variance is 800, categorized as unfavorable. Fixed overhead volume variance measures the difference between budgeted fixed overhead and amount applied to production based on the actual output. Given the budgeted fixed overhead is RM8,000 and the applied fixed overhead is 6,400, resulting from the multiplication of standard hour 3,200 and fixed overhead rate of RM2. Therefore, the variance is 1,600, classified as unfavorable.